The one chart that should concern you, if not outright scare you. It's weird how so many people get caught up in the inflation issue, like as if inflation is imminent because of government spending. I've talked about this a million times Sunday. And they say stocks are a hedge against inflation. There's no evidence of that. They say bonds will get smoked into inflation. You know, if you're locking in a long-term bond, it will get smoked if there's inflation. But the idea that the inflationary winds are here forever is just, I find that to be silly, man. And I'm going to share with you why right now, actually. Let's dive into this. This is the one chart that should scare you right here. Velocity of M2 money stock. M2 money stock, well, let's just read the definition of M2 money stock. M2 money stock is right here. M2 equals M1. M1 is coins and currency in circulation plus demand deposit accounts, that's checking accounts and traveler's checks. So whatever you have in your literally in your back pocket plus your checking account, that's M1. That's not what we're all that concerned with. We're more concerned with M2, which is M1, checking accounts plus savings accounts plus money market deposits, funds plus certificates of deposits and other time deposits. So remember, a checking account is a demand deposit account. That falls under M1 money supply because you can literally write a check. It's literally the same thing as currency, essentially. A TDA is a time deposit account. You can't write checking accounts. There's a time constraint on it, but still liquid relative to like a brokerage account or something like that. So M2 is what we're concerned with. So if we go back to money supply on M2, the velocity of money. So velocity of money, the turning over of money. Look at this. From 1959, it's 1.77. Went to right there, 1997, 2.174. The Fed was raising right here in 1994, and the Fed was raising again right here in 1999 because they're trying to nip inflation. Notice right here, the money supply, the velocity of money was jumping through the roof from right there, 1977 to 1981. The Fed beat inflation, that's what we think, by raising interest rates. But look at the money supply just tearing it up. In fact, if you look right here, 1972 to 1981, the velocity of money went from 1.7 to 925. And we have huge growth in these times right here from basically the late 50s. I don't say huge, but good growth, but stable velocity of money. Then a rising velocity of money. People are turning it over. Whether or not it was because of inflation and anticipation of inflation, it's almost like CO2 and global warming. What caused what? But anyway, and then you can see we had the velocity of money shrink. This is because inflation rates are high and whatnot. And interest rates, they beat interest rates. So we had this a little bit of recession right here. The biggest recession since the Great Depression is what people say, in the 1980 to 1982. And then he had a flattening of the velocity, and then basically from Clinton's time, spiking. And this is, we had high inflation, but we had lots of growth too. But then look at it since then, from 1998, the velocity to money down to here. Look at that. Never been this low before, ever. Interesting. If we go to trading economics, we can just look at it again in terms of a little bit of better, different chart. Same thing here. Look at that. Stable, big jump. Look at that. So I'm going to show you something here. The Japanese velocity of money as well. Just get an example. Look at that. So let's read. Accounting for the decline in the velocity of money in the Japanese economy. And this is Dateline 2000. I think I saw 2011 or something like that a few years back. Yeah. But if you read my man's book here, The Holy Grail of Macroeconomics, Richard Koo, you're going to see, if you read this, you'll say, whoa, that sounds a lot like the United States. So let's read this. A notable feature of the Japanese economy following the banking crisis of the late 1990s is the drastic decline in the velocity of money and the consequent decline in the price level. Based on the inventory model of money demand, a la a couple economists, we explore how macroeconomic shocks affect the velocity. Households in the model are subject to a multiple period cash in advance constraint in which the portion of the payment in cash, which we call the liquidity requirement, varies according to the credit service supply in the economy. Extracting various shocks from underlying the velocity variations from 1990 to 2010, we find that an increase in the liquidity requirement is the key driver in the decline of the velocity. The increase in the liquidity requirement. I'll explain that. Particularly important is the channel stemming from households' expectations about the future liquidity requirement. During the Japanese banking crisis and the global financial crisis, credit service is disrupted and households expect the disruption to last long. Since they demand additional money for a higher liquidity requirement for current and future transactions, the velocity and the price level decrease, even though the growth rate of money stock that exceeds that even though the growth rate of money stock then exceeds that of consumption. So the money stock is going through the roof, but the liquidity requirements of the households are increasing because like I need cash. I don't want to spend. I tell you, it's I'm telling you, man, the same thing. I never got to talk to this guy. He had tons of money, he could add tons of liquidity in terms of banks and all this. He is a general contractor in Missouri. Great guy. He says, I'll never take another loan again. I said, why? He goes, because, man, I had no income during the great financial crisis because I wasn't getting paid. My accounts receivables weren't getting paid. I wasn't getting paid. I had to carry my people by myself, essentially, for his subs. He goes, I couldn't just let them fly. They'll never work for me again. So he's had to carry for him because basically I could not get any liquidity. I had no liquidity. I could not get financing. And as such, he had to sell a lot of his portfolio. And he sold at a loss because he could not. He was relying on the banking industry to provide him the liquidity he needed to make good on his payroll. He was gone, so he had to sell his portfolio. He had to sell stuff. And I'm telling you, man, the same thing. Just put it this way. Say you're relying on liquidity at the bank to give you, I don't know, to buy a new TV or something like that. You're like, I don't know if these guys are going to be there. I don't know what's going to happen. I don't trust the system. I'm going to hold cash. Because the future, you're worried about the future, saying, I'm going to have a higher liquidity requirement because I don't believe what's going on out there. Now, generally speaking, the reason the velocity of money turns over fast in an inflationary time is simple right here. People think the cost of this, freaking loaf of bread is not going to be $1 today, it'll be $1.50 because high inflation. So I'm trying to move the money as quickly as possible out because I know it's going to be worth less if I hold on to it for an extra day. But what happens when people say, I don't even care. I just care that I need to have cash on the side. The velocity of money doesn't go down if people are worried about hyperinflation. I'm telling you right now. It doesn't. The velocity of money increases. No one wants to hold cash. Why would I hold cash if tomorrow's going to be worth 50% less? It doesn't make sense. The velocity of money is what the reason the velocity of money goes down. The velocity of money is because people have huge concerns about the future. They're holding onto the cash. And if we just see what my man Richard Koo says here, Richard Koo says this: as firms, we're going to substitute firms for households. As households strive to minimize debt, not only do they earmark cash flow for paying down debt, but they stop borrowing and investing the savings of the household sector. This creates a huge deflationary gap. As a real economy begins to weaken, the central bank will then lower interest rates. But the economy fails to respond, becomes firms, households, with debt overhangs are no longer interested in increasing investment. The central bank then panics and drops rates as low as possible. Even this is insufficient to provoke a response, which prompts the media to report that the economy is in a liquidity trap. But the trap actually began the moment that companies, households, began minimizing debt. We can now see why a liquidity trap has nothing to do with the level of interest rates. Instead, the trap is created the moment firms, households, shift their focus from maximizing profits to minimizing debt. I'm telling you, man, that's 100% right. When Japanese companies began shifting their priorities to debt minimization, American households began shifting their priorities to debt minimization. In 1993, short-term rates were still above 3%, and long-term rates were above 4%, leaving the central bank plenty of room to lower rates. Nonetheless, monetary policy had begun to lose its effectiveness. An economy in which everyone is drawing down from bank deposits to pay off debt, the money multiplier will turn negative at the margin because a decline in deposits means a decline in the money supply. The money supply represented by deposits is a liability for the banking sector. So for it to increase, banks must also have it increase. When the private sector is focused on paying down debt, only public sector borrowing and spending can prevent a contraction in economic activity. And so that's what he's saying, why the, like a modern monetary theory, MMT, Kelton, I think that's her name, Stephanie Kelton, makes sense when people aren't buying because the government's the only thing in town if you want to get the economy back on track. Well, they did that in Japan. Did not work. I mean, we can even look. So here's Japan right here. Look at that. Debt to GDP, by the way, 266%. Debt is deflationary. They're not running surpluses. Tiny jobless rates. Tiny inflation rates, negative interest rates, negative GDP Q over Q, quarter over quarter. They had one. Let's just look at GDP here for Japan. Growth rate. Let's see what we got here. We'll go to max. I mean, so look at this. We go back to 19 right there. Look, it's hovering around 0. Look at this. 0, 0, 0, 0. With all this from basically 1990, when they lowered interest rates, it's hovering around 0. But a couple years after the Great Recession came back to life, but now it's right back at 0 again. I mean, you can't. Let's see if we can see what does it Nikkei have done actually? Actually, let's just read real quick. I saw something that maybe it was interesting to me. The Japanese economy shrank by almost a full percent Q over Q in quarter 3, 2021, compared with market expectations of a 0.2% fall. And that's after downwardly revised 0.4% growth in Q2, amid a resurgence of COVID, whatever. On an annualized basis, the GDP contracted by 3% in the third quarter, compared to forecasts with a 0.8% decline. I mean, and that's following a 1.5% expansion. We used to want in the United States to get 3% growth. We're not even getting that. So let's see what, let's see if I can't find the Nikkei. Hold on a sec. Let's just look at Nikkei from basically, what's this, 1991. And from 2012, it went from 26,000 in 1991 to freaking 8,500 in 2012. Now it's back up to 27,000. So it's gone up 300% in the last 8 years or so. But they're not getting any growth, not getting any earnings, not enough to. I mean, this is just look at that. We're right back to where we were 30 years ago. Anyway, the point being is, if you're not having growth in the earnings sector from the economy, you're not going to have stock market performance like we've seen historically. Anyway, the point being is, and again, what happens in deflationary times is debt becomes debt's always the enemy, but deflation costs a heck of a lot more when there's not much inflation. That's just debt. Did I say debt costs a lot? What did I say? Deflation? I can't remember. Debt costs a lot more when there's not much inflation, when it's actually deflationary, which is why Japanese were spending down. They're saying, look, the economy's going south. That's deflationary, recessionary. It's not inflationary. Thus, I'm going to pay down my debt because it's more expensive to carry debt during deflationary times. Yeah, short-term inflation, 100%. That's no staying power. It just doesn't. All right, love your thoughts. We'll see you.